Good afternoon. Relevance is the fundamental, the qualitative characteristics of financial statements, financial reports. And from today onwards, in this session, we will discuss about materiality. It's coming under relevance. Right? The relevance matter is not yet finalized. Still, it continues. Materiality. In the previous lectures, I have clearly explained what is materiality. In our words, we can say that the materiality means importance. This importance is decided by, this materiality is decided by the users of the financial information. So as I can remember, I explained you using the example of for some people even 10 rupees, 100 rupees is material. For some people, 1,000 rupees, 10,000 rupees is not material. Right? So the level of the amount of materiality depends on the user of the financial statement as well as the accountant, preparers. Not only in rupee value, monetary value, the materiality is come from other information also, information side also. So when in our life, in our personal life or whatever the life, there are so many informations come across ourselves, but we are not taking every information seriously. A matter for us may not serious for us, but it will highly impact on others. For example, in our current scenario, there's a coastal disaster in our Western Ocean, our country's ocean. A lot of people have lost their lives. The fishermen have, a lot of them have lost their lives because of the incident in the western side of our Sri Lankan Ocean. In our side, it's a news. It's just a news. We are not impacted severely here. But for those people who are living in western coastal of Sri Lanka, they are seriously affected. For them, this information is material. For us, it's not material. For example, right? So in COVID cases, the spread of COVID cases in our area at present situation here, especially in Eastern, it is not much serious. But in other areas, red warning areas, there is more sense. In India, there are more and more sense. So each and every informations for some people material, for some people not material. So it is qualitative characteristics. Relevance, materiality. Here, information is material if omitting. So someone else hide the information. Information is material if omitting it or misstating it, wrongly disclose the information. Misstatement, wrong information. So sometimes they may omit, they may hide the information, or they are differently state that information. So both of these activities can mislead the user of the financial information. So information is material if omitting it or misstating it could influence the decision that users make on the basis of financial information about a specific reporting entity. So there are a lot of things may happen in a company's context in accounting background, but not all the incidents, informations are not disclosed in financial reporting, since we are using general purpose financial reporting we are reading on. But there are some informations that should disclosed for the shareholders, investors, who are the primary user of financial statement. So that information is necessary to take the decisions, to make a decision, whether they keep the stock, whether we can buy stock or we can sell the stock, that sort of decisions they have to take. For example, a serious court case, serious non-compliance. Due to non-compliances, the company facing a very serious case. If the company lost in this case, definitely company will be closed down. For example, assume that if the company is not disclosed or omit, they are not disclosed this information to shareholders, what will happen? It is definitely will impact on their decisions. If they disclose that information as the factual information, what will happen? They will take decision, whether they can take, whether keep the shares or sell the shares, that sort of decision they can take. Right? So by hiding this information, the users, the investors are unable to take the decision on time. So hiding that decision also impact, and also sometimes misstatement, right? Some misstatement. They are disclosing the wrong information, right? So that information also will impact on share price. There are a lot of rumors, right? There are a lot of rumors for the purpose of damaging the shareholders' value, or for the purpose of reducing the market share price. So for that reasons, sometimes they may purposefully disclose some wrong information. That's called, that is expressing wrong information in accounting terms we call as misstatement. So omitting is hiding the information, and misstating is expressing the wrong information. So that kind of if that hiding or omitting or misstating is happen, that if it is impact on the decision makers, that information is material. So information is material if omitting it or misstating it could influence the decisions that users make on the basis of financial information about a specific reporting entity. Reporting entity means simply organization, a business. In other words, materiality, important sometimes called, materiality is an entity specific of relevance, entity specific aspect of relevance based on the nature or magnitude or both of the item to which the information relates in the context of individual entity's financial report. You know, the COVID pandemic, for some organization, it's highly adversely impact. For some industries, this COVID pandemic is not a matter. For example, think about IT companies. Earlier, before COVID pandemic, they also do the work from home. Every week or every month, they just visit the office. But most of the works are done at home by the employees. Even though the pandemic comes, their industry, their employment is not impacted. So this COVID pandemic, it is even though it's a material information, but it's a magnitude, the seriousness is low. For the manufacturing companies, the spread of COVID pandemic is adversely impact. So compare the impact of IT companies and manufacturing companies. Let's say garments. Compare this impact of the COVID pandemic. Definitely the manufacturing companies, garments affect very seriously. And some companies, due to this COVID-19, improve their businesses, improve their value. Think about dialogue, think about SLT, think about Mobitel. So they are when you observe their prices, it increases because of their performance. Why do they perform well before COVID-19? Because of they are positively impact. So this COVID information now, the first wave, second wave, third wave, this kind of waves, it may be a material information for mobile phone, so SLT, because when a new waves comes, new pandemics comes, many people are relies on internet, so their performance will go up. It's positively impact. So this kind of information is immaterial. This COVID-19 information is important for some companies because they may positively affect or negatively affect. But in case of IT company, IT related industry, this COVID information is not necessary. It is not material. It is not material. So they don't want to report. The IT companies no need to report about the consequences of pandemic on their financial report. But in garments factory, they have to disclose. So due to this pandemic, how many days the company, the factory was closed down. They have to disclose under the extraordinary items or in the note. This information. So otherwise, if they are not disclosed this information in the future period, that time the performance of the company may go down, goes down. So if they not disclose the information, the users unable to understand why the company's performance was down. So think about after 10 years. Right? So some informations are important. This information is necessary to take decisions. If that information is important, then we can conclude that that information is material, important. That information is important. So whatever the informations are impact on the users of financial information, that informations are material. So consequently, a uniform quantitative threshold for materiality or predetermine what could be material in a particular situation cannot be specified. For some companies, thousand rupees are not material. So in our Sri Lankan context, normally we hide 3 zeros. We hide 3 zeros. We are not consider last 3 zeros, thousands. For some companies, they are hiding 6 zeros, million. Right? The material level is million. In Europe or well-developed countries, they are hiding billions. No, they are preparing financial statement in billions. They are hiding 9 zeros. So it is how many zeros they have to hide. It's based on the materiality. For small shop, even the stapler, even the bulb, also a material asset. So it depends on. So it depends on the entity. So that's why it says no uniformity threshold. There is no uniformity threshold. Consequently, a uniform quantitative threshold for materiality or predetermine what could be material in a particular situation cannot be specified. So how much? So what information is material? So that kind of decision cannot be decided generally. So it depends on a particular company, organization. Faithful representation. Faithful means we believeness, the creditability. How the information is believable, faithful. Earlier we talked about relevant. We have to take the information from the relevant person. We have to take the information from relevant person. That's if we take the information from a relevant person or relevant source, that will be a qualitative characteristics. And faithful representation. Even though we are getting the information from the correct source, but information is not reliable. Information is not reliable. So this time the faithfulness is low. To consider information as a qualitative information, it should have two things. The information should take from a relevant source, and the source should be faithful, right? Believable. Financial report represent economic phenomena in words and numbers. To be useful, financial information must not only represent relevant phenomena, but it must also faithfully represent the phenomena that it purports to represent. Faith. We have to believe, the degree of believeness. To be a perfectly faithful representation, a depiction would have three characteristics. To conclude whether information is faithful, we have to check it out three characteristics of that information. First one, complete, whether the information we are receiving is complete. Neutral means without bias. So some people make judgment not based on the subject, rather they are giving judgment based on their person. If I am a more rich person or well-educated person or well-known person, if I get the information, they are giving some information, or the very poor people or uneducated people asking for information, they are giving another information. So not like that. Neutral. So whoever asks information, at what the circumstances, the information is neutral without any bias. That is called neutral. So free from error. You know, it is obvious. Free from errors. There is no mistakes. Completeness, neutral, and free from error. If we find these three characteristics, then we can say that the information is faithful. And if we find these things in the financial report, and we can conclude that the financial reports give a faithful representation. So it's a very simple form to explain what is faithful representation. So faithful representation is the sum of completeness, complete information, and neutrality, no bias, and free from error. So sum of these three equal faithful representation. Now we'll discuss one by one. Completeness. A complete depiction. Complete means a complete source. A complete includes all information necessary for a user to understand the phenomena being depicted, including all necessary descriptions and explanations. You know, so when you take any report, it should give you a complete information regarding what you need. It gives you the complete information. If it is so, it's called a completeness. So it includes all information, right? It should provide all information necessary. Not all information is available. Yeah, not available information. We are considering all information necessary for a user to understand the phenomena. To understand a particular phenomena, a report should give all the informations, all the necessary informations being depicted, including necessary description and explanation. That's why the financial report, annual report with financial statements, they are attaching what? Note to give a complete information. The statements is not enough. That's why they include a fifth element of financial statement as explanatory notes. Explanatory notes. For example, a complete depiction of a group of assets would be included at a minimum of, right? When you see the property, plant, equipment, you know, when you see the financial balance sheet, when statement of financial position, you can find an item called property, plant, and equipment. It is prepared based on their LK 16. But by looking at that, you couldn't find a detailed information. If you want more detailed information, you have to go to the note section. In the note, they will explain not all information, they explain necessary informations there. For example, a complete depiction of a group of assets would include at a minimum of description of the nature of the asset in the group, whether how much plant, how much machineries, how much furnitures, how much motor vehicles, that stuffs, the nature of the assets in the group at least. A numerical depiction of all the assets in the group. So they have divided in terms of numerical value, rupee value, how many vehicles, how many machineries, like that. A description of what the numerical depiction represent. Description of what the numerical depiction represent. For example, original cost, adjusted cost, fair value. You can find a book value, accumulated depreciation, fair value. Sometimes you can find impairment. For some items, a complete depiction may also entail explanations of significant fact about the quality and nature of the items, factors and circumstances that might affect their quality and nature. For some enterprises, for some organizations, the full detail about the inventories are very important. For some companies are not important. Think about jewelry business. So they have every day they are counting stocks. Every day when they are closing their jewelry, so they are taking stock, take down the stock. And you compare a rice mill. Every day they are not taking stock count. And the bricks construction, they're making bricks, use of sands. And think about construction companies, they are not taking every day. For jewelries, so that sort of complete information is necessary. For some organizations, that much detail is not important. So based on the nature. What is necessary, what is not necessary is based on their nature. So we can say, in other words, based on the materiality of that information. The process used to determine the numerical depiction, so that also should include how they determine the numerical depiction also necessary. Now we'll discuss about neutrality. Neutral, no bias. Whoever asks for information, they are giving the same information, regardless with their power, with their race, with their color, with gender. No, without any bias, they are giving a neutral information. A neutral depiction is without bias. In the selection or presentation of financial information. A neutral depiction is not slanted, weighted, emphasized, de-emphasized, or otherwise manipulated to increase the probability that financial information will be received favorably or unfavorably by user. So in simple term, whoever asks for information, they are giving actual information, factual informations. Some so bias mean without neutrality mean, so the information is differ person to person, time to time. Without that, it should be neutral. Neutral information does not mean information with no purpose or no influence on behavior. So we cannot assume that. So neutral information does not mean information is no purpose, no value. Information has no value, no influence on behavior. No. Information should give whoever it needs. The value of the information is depends on the user of the information. On contrary, relevant financial information is by definition capable of making a difference in users' decision. For some users, some informations are more relevant. For some users, that information, the same information, is not important. So the information, the capable of making a difference in users' decisions. So as per the responsibility of accountants, they have to give all informations whoever needs that information. Relevant, they have to give a neutral information regardless the person. So the decision is based on the user side, and the information provider not think about it. But when they give information, ask for information, they have to give without any bias, neutral. So they don't want to ask why you asking information. They can't, they unable to ask this question, why you are request. Right, the third characteristics of faithful representation is free from error. Free from error means there are no errors. Free from error means there is no errors or omissions in the description of phenomenon, and the process used to produce the reported information has been selected and applied with no errors in the process. It should give a fair presentation. Fair representation mean we cannot say it's 100% true. There are some errors, but it's fairly, it's fair, it depicts true and fair view. Free from errors. Free from errors means there are no errors or omissions in the description of the phenomenon, and the process used to produce the reported information has been selected and applied with no errors in the process. That's why the companies are employing auditors. And they have developed internal control system, internal checking, vouching, verification, that sort of stuff they have. Because of the financial information should, financial report should represent faithfulness. So in this context, free from error does not mean perfectly accurate in all respect. So as I told you earlier, it is not 100%. It doesn't mean all informations are 100% error free. So we have to take a reasonable degree of perfection we can expect. For example, an estimate of an unobservable price or value cannot be determined to be accurate or inaccurate. However, representation of that estimates can be faithful. Representation can be a faithful. So when you calculate provision for a doubtful debt, provision for doubtful debt, so it's an estimation. It's not a factual value, actual value. Anyhow, you have to make a reasonable provisions. And when you make depreciation, you have to have a fairness of a faithful estimation on depreciation. And when you count stocks, you have to count the stocks in a fair manner. So, however, representation of this that estimates can be faithful if the amount is described clearly and accurately as being an estimate. The nature and limitation of the estimating process are explained, and no error have been made in selecting and applying appropriate process for developing the estimates. So whenever they are applying estimates, they have to clearly explain what the process they have followed to estimate the value. So this is what, so when the users read, go through this process, they can understand so how do they have evaluated. In summary of faithful representation by itself does not necessarily result in useful information. So faithful, it doesn't mean of useful. Faithful representation is doesn't mean a useful information. So it may be useful some people or it may be not useful. For example, a reporting entity may receive property, plant, equipment through a government grant. Now, government has given some sort of plant. Obviously, reporting that an entity acquired an asset at no cost would faithfully represent its cost, but that information would probably not be very useful. A slightly more suitable example is an estimation of the amount by which an assets carrying amount should be adjusted to reflect an impairment in the assets value. Now, sometimes the companies make some impairment on the assets. Impairment is more than the depreciation. So, in that every year they are making a depreciation 10% of their cost. But due to the market conditions and due to the technological changes, the market value is suddenly reduced, maybe suddenly reduced. So they have to depreciate more than that. So that time they have to impair, damaging, no? Impairment, the same what is damage, impairing their value. So in that case, they have to explain in their things, they explain their processes, how do they estimate their impairment. That estimate can be faithful representation, so it's complete, it is free from error, it is not biased. So that's mean the faithful. That estimates can be faithful representation if the reporting entity has properly applied and appropriate processes, properly described the estimates, and explained and any uncertainties that significantly affect the estimates. So in that case, they have to provide, depicts all the relevant information. So that time only it becomes a faithful representation. So this representation may not useful, but anyhow they have to depicts. So how do they impair the asset? It may not useful information, but the full representation is one of the more fundamental characteristics of financial reporting. Therefore, they have to depict. They can't judge based on the whether this information is useful or not. Rather than thinking like that, rather than thinking this information is useful or not, they have to depict. They have to disclose that information. However, if the level of uncertainty in such an estimate is sufficiently large, that estimate will not be a particularly useful. In other words, the relevance of the asset being faithfully represented is questionable. So if there is no alternative representation that is more faithful, that estimate may provide the best available information. Now let us apply the fundamental qualitative characteristics. So what are the fundamental qualitative characteristics? First one is relevant, second one is a faithfulness, faithful representation. Information must be both relevant and faithfully represented if it is to be useful. If it is to be useful. And neither full representation of a irrelevant phenomenon. No, so they are they are showing irrelevant. They are giving us irrelevant irrelevant things, or no, an unfaithful representation of a particular phenomenon helps users to make decisions. No, so irrelevant source of information, irrelevant informations, and unfaithful representations will not helpful to the users. Right? Neither a faithful representation of no, the information is faithful, but not relevant, faithful is there but not relevant. And the second case, the information is relevant but not faithful, unfaithful but relevant. So these two scenarios will not help to the users. So at a time, both a relevant and faithful representation should be there. If one fails, the information is not useful. The most efficient and effective process for applying the fundamental qualitative characteristics would usually be as follows. First, identify an economic phenomenon that has a potential to be useful to the users of the reporting entity's financial information. So first they have to decide whether have to disclose the information to the users, whether the information is useful to take decision to the users. First they have to decide that one, because disclosing information is a costly thing, right? So they don't want to they don't want to disclose all the informations available in the company, in the organization, but rather they have to disclose the information that are useful to the users. So when they disclose information, it should meet relevant information and faithful representation. First, they identify economic phenomenon. Economic phenomenon means no, it's a cost and benefit analysis. No? Economic phenomenon that has a potential to be useful to users of the reporting entity's financial information. Second, once they have decided whether do we have to disclose that a particular information. For example, in a manufacturing company, they have a plant. Think about, for example, a cement factory. You can find a large plant, a big plant. So it is not necessary that how many bolt, how many nuts, how many pins, how many clips are available in the company, in the factory. No need to disclose that sort of information, because these informations are not useful. But they have to disclose what is the value of the plant, and what's the capacity of that plant, and for how long it can be used. So are there any threats due to the technological changes, environmental issues? So that sort of stuff they can disclose. That is reasonable. So that can be useful to take decisions. So if they are disclosing how many nuts, bolt, pins, clips, it is not important. Right? Even though it's information, but it is not important. So once they decide that this information should be disclosed, then they have to second identify the type of information about the phenomenon. that be most relevant if it is available and can be faithfully represented. Secondly, right? So then they have to they move to identify what type of information about. So in the first step, they have they have decided to disclose about the plan, and then they have to decide what type of informations they have to disclose. Type of information about the phenomenon that would be most relevant if available and can be faithfully represented. Third, determine whether information is available and can be faithfully represented. Then they have to decide so whether the information is available. They have to check the information is available or not. And also they have to think whether the information we are going to provide is faithful representation. Faithful representation. If so, then the fourth step, if so, the process of satisfying the fundamental qualitative characteristics and ends at the point. I can explain using a diagram. If they fails, if not, the process is repeated with the next most relevant information. Here, this is the diagram. You can find first, you have to identify academic phenomenon. Identify in academic phenomenon that has the potential, to be useful. We decide first whether the information is useful to the users of reporting entities financial information. First, they have to decide whether the information on that economic phenomenon is useful or not. Yes, if the answer is yes, it is useful, then they have to come to the second step. Identify the type of information, what type of information we are going to disclose in the financial reporting to the users. Identify the type of information about the phenomenon that be most relevant. They are giving not all the informations. They have to give most relevant informations, from the relevant sources. They will take information, most relevant information, if it is available and can be faithfully represented. So it should meet two criteria. So the information should be relevant, and also the information should give a faithful representation. And if they meet two criteria, then they can go to the third step. So determine whether that information is available and can faithfully represent it. They have to decide the third one. If the answer is yes, they can disclose. If if the information is not available, then they have to go for the next best alternative informations regarding that phenomena. Excuse me. If the answer is not, again, the information is not faithfully represented, then go back and again identify the type of information. First, we already decided, initially we have decided that we have to disclose that information. The second, they have to identify what are the informations, the type of informations. So whether the information is irrelevant and it depicts faithful representation. So if they made two criteria, then they go for available informations. If the information is available, they can report. If the information is not available, they have to find for the next best alternative information. Now we'll see the second part, enhancing qualitative characteristics. We already discussed about the fundamental qualitative characteristic. Now we move to the second part. You can find in the slide. Right. Here, qualitative characteristics of useful financial information. So first we already discussed fundamental qualitative characteristics. So that's one, relevance and faithful representation. So we have discussed in detail. Now we move this slide, enhancing qualitative characteristics, and we have to discuss four things: comparability, verifiability, timeliness, and understandability. Now let's move one by one. Right, enhancing qualitative characteristics. So these are the characteristics that enhance the usefulness of information that is relevant and faithfully represented. Right, these are the characteristics. So these are the characteristics that enhance. These characteristics will enhance, add value of useful of information. But that information relevant and faithful representation. So even though you have at whatever the values, if it is fails in relevant and faithful representation, that enhancement is useless, not work out. The enhancing qualitative characteristics may also help to determine which of two ways should be used to depict a phenomenon if both are considered equally relevant and faithfully representation. Enhancing the quality characteristic may be also help, uh, the enhancing characteristics helps to determine of which of two ways should be used to depict a phenomenon if both are considered equally relevant and faithfully represented. Right, now we move what are the usefulness of financial information is enhanced. The usefulness of financial information is enhanced if the information is comparable. It can be comparable with the same entity. So comparable with one entity to another entity. So we can compare the performance of Sri Lanka Telecom and Dial-up and Mobitel. So it's kind of comparability, right? And we can compare the performance of Commercial Bank of Sri Lanka and the HNB, Sambat Bank. So it's kind of comparison, compare between entities. And also another comparison, compare the performance of the company this year with previous years. 2020 performance, 2021 performance, 2015 performance, 2016 performance. So compare across the timeline for the same institutes, four entities. Verifiable. So sometimes if the users may be doubt on that, they may ask for evidence for that information. In that case, that should be verifiable. So that's what for all the transaction they should keep evidences. When audit comes to the entity, they will collect evidences for their representations. Timely, so now up-to-date information. It should provide up-to-date informations and understandable. So whoever have reasonable knowledge on that, those people able to understand without much complexities. Now we'll first discuss about comparability. Compare. Information about a reporting entity is more useful. Information about a reporting entity is more useful if it can be comparable. Similar information about other entities and with right, other entities like HNB, Sambat Bank, Ceylon Bank. So the HNB performance of the HNB can be comparable with other companies, competitive companies in similar nature. And also similar information about the same entity same entity for another period or other date. Compare this information with previous year. What about the performance of in the last 2 years, last 2 decades? So that sort of comparison also can be done. Comparability and qualitative characteristics that enables the users to identify and understand similarities and differences among the items. So when you compare Sambat Bank and Ceylon Bank, we can identify what are the similarities, in what nature both of these banks are similar, in what aspects those both banks are differs. So you can these understanding similarities and differences is possible when it facilitates to compare. When facilitates compare. Unlike the other qualitative characteristics, comparability does not relate to a single item. A comparison requires at least 2 items. So we need at least 2 firms. The HL performance of Sambat Bank can be compared with Ceylon Bank or Commercial Bank or HNB. So at least minimum 2. And also in the timeline. So to compare the performance of the same entities previous performance, we need previous year financial informations. So then only we have to compare. So it's a normal thing. Everybody's know to compare we have to have at least 2 things. Comparability. Here X is the firm, T is the time period. X is the time. T means today in 2021. Then it can be compared with T minus 1. So year minus 1. So here T equal 2021 minus 1 equal 2020. So we can compare performance of previous year with current year. So it's called internal comparison. Internal comparison. And this is firm X, same period, firm Y, same period. So 2 different entities in same period is called external comparison. So same company, right? Same company, but in different periods called internal comparison. And same period at different companies is called external comparison. Comparability and consistency. Consistency, mean it's fixed. It's like a fixed. Consistent means it's kind of fixed policy. So consistency in depreciation. It's mean in the last year they are following. They follow straight line method. This year straight line method. Next year should be straight line method. So it is consistency of policy. It is consistency of policy. So consistency, although related to the comparability, is not the same. Consistency, although related to comparability, but it is not the same. Consistency is different from comparability. Consistency. So if they follow consistency of policy, then only we can go for comparability. Right? Consistency refers to the use of the same method for the same item, either from period to period within the reporting entity or in a single period across entities. We can compare Ceylon Bank with Sambat Bank because those 2 are similar in nature. Do we compare Ceylon Bank with NSB? It is not. It's not. The operation of NSB is different from the Ceylon Bank. The performance of NSB compare with Brandix. That's a garment company, garment factory. apparel company, apparel industry. So the Ceylon Bank performance of the Ceylon Bank cannot be compared with Hilton or Icon Spencers. Right? So when we compare anything, it should be consistent. No? So if they are in the same industry, it's okay. Right. Consistency refers to the use of the method for the same item, either from the period to period within the reporting entity or in a single period across entities. Comparability is the goal. Comparability is the goal, right? To achieve the goal, consistency will help. Comparability is the goal. Consistency help to achieve that goal. Comparability is not uniformity. Comparability is not uniformity. For information to be comparable, like things must look alike and different things must look different. Here we have to compare the depreciation expenses of the company. The last year depreciation was 10 million, this year was 5 million. So when we compare these two figures, we can come to the conclusion that this year the depreciation expenses will go down. Depreciation expenses has go down. So there's a lot of saving. But when we go in detail, the last year they have used depreciation in straight line method, but this year they are using reducing balance method. So the methods are different. So due to that differences, that impacts on the depreciation amount. So in that case, there is no consistency of policy. So therefore, we can't compare the performance in those 2 years. Comparability is not uniformity. Comparability is not uniformity. For information to be comparable, like things must look alike, right? Like things must look alike. Different things must look different. Same thing, similar things look same. Similar things look same. Different things look different. Comparability of financial information is not enhanced by making unlike things look alike. So different things look similar. Different things look similar, or any more that it is enhanced by making things look different. Similar things looks different. No? Comparability of financial information is not enhanced. It's not enhanced by making different things similar, different things as same. Some degree of comparability is likely to be attained by satisfying the fundamental qualitative characteristics. The faithful representation of relevant economic phenomenon should naturally possess some degree of comparability with a faithful representation of a similar relevant economic phenomenon by another reporting entity. Although single economic phenomenon can be faithfully represented in multiple ways, permitting alternative accounting methods for the same economic phenomenon in comparability.